Good evening. Imagine waking up one morning to find that your digital cash is not yours. It's controlled, surveilled, recalled, or devalued at a whim. That isn't science fiction. That's the reality we risk when stablecoins become the CBDCs of our future. We are entering a period of profound structural stress in the global economy, something that is not the result of a single event, but rather the compounding of many interconnected imbalances built up over decades. What's happening now is the convergence of long-term debt cycles, geopolitical realignments, monetary experimentation, and technological disruption, all of which are pushing the financial system toward a moment of reckoning. When debt levels rise faster than incomes for long enough, you eventually hit a wall. That's where many advanced economies are now. Public debt to GDP ratios in places like the U.S., Japan, and much of Europe are not just historically high, they're unserviceable without constant refinancing at lower interest rates or through monetary debasement. But inflation has returned, making ultra-loose monetary policy unsustainable. Central banks are caught in a trap. Raise rates to fight inflation, and you increase the cost of servicing debt. Keep rates low, and you risk further inflating asset bubbles and weakening your currency. There is no easy exit. At the same time, the global order is fragmenting. For decades, the dollar-centered system offered stability, even if it was imbalanced. The U.S. ran large trade and fiscal deficits while exporting dollars and debt. In return, it got geopolitical influence, military reach, and the reserve currency status. That arrangement worked as long as everyone played along, but now major economies are de-risking from one another. We're seeing China and Russia build settlement systems outside of SWIFT, commodity trading shift into other currencies, and a general trend of nations seeking greater monetary autonomy. This shift erodes the network effect that underpins dollar dominance. Within this context, technology is changing the plumbing of the monetary system. Digital assets, blockchain settlement layers, tokenized banking. These are not minor innovations. They represent a full redesign of how value moves. But while some see that as liberating, the transition is also introducing new systemic risks. Financial markets today are complex adaptive systems with high interconnectivity. When you inject new forms of money that are not fully backed, regulated, or understood, such as stable coins, you increase the potential for nonlinear outcomes. Contagion can move faster than regulators can respond. What's often misunderstood is that liquidity itself is a confidence game. People accept currency not because it's inherently valuable, but because they believe others will too. Once you compromise that trust by diluting purchasing power, freezing assets, or failing to back digital representations with real reserves, the entire system starts to destabilize. We've already seen this in shadow banking in 2008, and more recently in crypto exchange collapses. Now, the same dynamic is migrating into mainstream finance. Add to that the rise in populism, polarization, and social unrest. In a world where economic inequality is growing, where living standards feel stagnant for most people, and where institutions are losing credibility, it becomes harder for policymakers to make disciplined, long-term decisions. Instead, short-term solutions dominate: more spending, more stimulus, more money printing. These are symptoms of a system trying to avoid necessary but painful adjustments. So when you look at the macro picture, it's not just about a weak currency or excessive debt or speculative tech. It's about how all of these elements interact and reinforce each other. We are operating under a regime of suppressed volatility where apparent stability is masking growing fragility. The next disruption, be it geopolitical, monetary, or technological, may not be contained as easily as the last. The system has fewer buffers, less trust, and more exposure. That is the risk context we are in, and it's one that demands real diversification, not just in portfolios, but in thinking. The emergence of stablecoins has been largely celebrated as a breakthrough in financial innovation, providing the speed and convenience of crypto with the familiarity and stability of fiat currencies. But beneath that surface lies something far more consequential. These instruments are not neutral. They are not just benign facilitators of commerce. They are mechanisms of control and fragility, and their unchecked proliferation could reshape the very architecture of money in ways most people are not prepared for. To understand the systemic risk, one has to go back to first principles. Money is a claim, a social contract backed by trust in its issuer. For most of modern history, that issuer has been the sovereign state. Even when banks issue credit, they do so under regulatory oversight, capital requirements, and with recourse to lender of last or support in times of crisis. Stablecoins, on the other hand, operate in a gray zone, issued by private companies, backed by varying mixes of fiat deposits, commercial paper, or even other crypto. They are only as sound as the institutions and assumptions behind them. Yet they are being adopted at scale as though they are equivalent to dollars or euros. This dynamic creates a twofold problem. First, there's the illusion of safety. Users treat stablecoins as if they were dollars, but unlike sovereign currencies, they are not legal tender, not fully backed in transparent ways, and not guaranteed by a central bank. When the underlying assets are tested, during market stress or liquidity runs, the peg can break and the confidence that sustains their value can evaporate in real time. We've already seen this with algorithmic stablecoins, but even reserve-backed ones face similar vulnerabilities if redemptions spike or collateral loses value. Second, there's the centralization of power. Ironically, while the original vision of crypto was decentralization, stablecoins move in the opposite direction. They are issued by centralized entities that determine who can hold them, who can transact, and under what terms. With programmable features, they can enforce blacklists, freeze accounts, or reverse transactions. This is not speculation. It has already happened. The risk is not just that a private company might abuse that power, it's that they become gatekeepers to financial access, shaping the flow of capital and the structure of markets outside of public oversight. Moreover, stablecoins subtly erode the monetary sovereignty of states. In emerging markets especially, dollar-pegged stablecoins introduce de facto dollarization, weakening central banks' ability to conduct monetary policy. As stablecoins gain traction in domestic transactions, the local currency becomes less relevant, and the central bank loses the tools it needs to stabilize inflation, manage employment, or respond to external shocks. The financial infrastructure becomes more dependent on foreign standards and domestic resilience declines. It's also important to recognize how this fits into a broader pattern. Throughout history, when private money becomes dominant, instability follows. In the 19th century, U.S. state-chartered banks issued their own notes, leading to frequent panics, wildcat banking, and uneven economic development. It was only after decades of crisis that a centralized monetary authority was established. Stablecoins are repeating that cycle, but at digital speed and global scale. In the short term, they appear efficient and innovative, but in the long term, they embed fragilities. opaque collateral, governance conflicts, and misaligned incentives that could amplify systemic shocks. If one or more major stablecoins were to fail during a broader financial downturn, the contagion wouldn't just be limited to crypto. It could reverberate through payment networks, trading venues, and even traditional banks that have integrated these instruments into their systems. This is not a matter of ideology, it's a matter of system design. When the money layer is rebuilt by entities whose primary obligation is not to public welfare but to shareholders, you don't get resilience. You get risk concentration. And when that risk is misunderstood or underestimated, it doesn't just challenge the stability of assets. It undermines trust in the system itself. That is the real danger we face. The nature of money is inseparable from the power to shape economic outcomes. When that power is diluted, outsourced, or undermined, the entire structure of a nation's sovereignty is called into question. What's happening now is a slow but accelerating shift in who holds the levers of monetary influence, not just from public to private hands, but from national frameworks to supranational and algorithmic ones. This transformation, while masked by the language of innovation, carries profound implications for how countries manage their economies, respond to crises, and preserve autonomy. Historically, central banks have relied on a set of tools: interest rates, reserve requirements, open market operations, to regulate credit and liquidity. These tools depend on one critical factor: that the unit of account and the instruments of payment are under the jurisdiction of the state. When money remains within the regulated banking system, policy decisions translate into real effects, stimulating or cooling demand, managing capital flows, and containing systemic risks. But when significant volumes of economic activity shift into parallel systems, especially those built on digital instruments not issued or governed by public entities, those tools begin to lose their potency. Stablecoins, in particular, are accelerating this process. They function as digital proxies for sovereign currencies, often the U.S. dollar, but are issued by private firms with their own rules, reserves, and interests. When these tokens begin circulating widely, especially in jurisdictions with weak financial institutions or high inflation, they don't just offer an alternative, they begin to displace the official monetary system. And that displacement is not just symbolic. It reduces the velocity and reach of central bank money, complicating efforts to set rates, regulate liquidity, or stabilize the economy during shocks. The issue intensifies in economies already exposed to dollar dominance. Many emerging markets have struggled to develop deep, stable capital markets in their own currencies. The introduction of dollar-pegged stablecoins effectively cements that dependency, bypassing local financial infrastructure and anchoring domestic activity to external monetary decisions. In such a setting, the central bank may exist in name but functionally lose its influence. Policy becomes reactive, constrained, or even irrelevant. Inflation targeting loses precision. Liquidity provision loses traction. Credit cycles decouple from the real needs of the domestic economy. Another layer of concern emerges when these digital assets are not just payment tools, but integrated into lending, asset management, and trade settlement. In that world, monetary control doesn't just weaken, it fragments. A decentralized system might sound ideal in theory, but in practice, what arises is a patchwork of semi-sovereign platforms, each governed by code, corporate policy, or opaque reserve mechanisms. This makes it harder for regulators to monitor flows, enforce capital controls, or coordinate in times of stress. And the more sophisticated the system becomes, the more brittle it gets, because complex interdependencies increase the chances that small errors or shocks cascade into large-scale dysfunction. From a geopolitical perspective, this loss of control is not just economic, it's strategic. Nations that can't manage their own money, can't defend their economic interests, they become subject to foreign monetary conditions, vulnerable to digital capital flight, and dependent on platforms whose decision-making is unaccountable to democratic institutions. That's not just a technical problem, it's a sovereignty crisis. None of this is hypothetical. The seeds are already planted and the trajectory is clear. Monetary sovereignty is being eroded, not with a bang, but with the quiet efficiency of code and convenience. And as the architecture of money drifts further away from the institutions designed to preserve stability and public interest, we may find that what we've gained in speed or access has come at the cost of control, resilience, and ultimately, freedom. The sooner that risk is recognized, the better positioned we'll be to adapt, not by resisting change, but by shaping it with intention and accountability. In times of rapid change, when trust in institutions begins to erode and the future of money itself becomes uncertain, it becomes essential to differentiate between assets that are dependent on the system and those that are independent of it. That's where the distinction between gold and silver versus digital or fiat instruments becomes not only relevant but urgent. Because unlike currencies that require confidence in a government or tokens that rely on algorithms and third-party collateral, precious metals are not contingent on promises. They are value in and of themselves. Gold and silver have served as monetary anchors for millennia, not because of superstition or nostalgia, but because they meet fundamental requirements that most modern instruments don't. They are durable, divisible, scarce, and universally accepted. Their value does not depend on a central bank's interest rate decision, a stablecoin issuer's reserve practices, or a smart contract's code integrity. They are physical, finite, and unyielding to political manipulation. That's precisely what makes them valuable in times like these, when the credibility of debt-backed systems is wearing thin, and when the very structure of money is shifting from tangible trust to abstract layers of programmable logic. What makes the comparison especially stark is how these metals behave in relation to credit. Credit-based systems function well during periods of expansion, when debt is rising, inflation is subdued, and confidence in institutions is strong. In those conditions, fiat currency and even digital equivalents can appear superior, faster, more flexible, more scalable. But when credit cycles reverse, when inflation outpaces wages, or when political instability makes future repayment questionable, those very instruments become liabilities. The more they depend on trust, the more vulnerable they become to its breakdown. Gold and silver are the opposite. They don't default. They don't rely on counterparties. Their risk is not in their function, but in their neglect. And yet, they are often dismissed by modern finance as relics, non-yielding, inert, outdated. But that criticism fails to grasp their true role. These metals are not meant to compete with credit. They are meant to anchor it. They don't substitute for productive investment. They safeguard it when systems malfunction. They are not about speculation. They are about preservation. When the unit of account begins to fluctuate wildly, when monetary policy becomes less about balance and more about reaction, when the money supply expands not because of growth, but because of necessity, gold and silver stand apart as the baseline. There's also the matter of accessibility. Gold is often seen as the institutionally preferred hedge held by central banks, sovereign wealth funds, and large investors. Silver, while possessing many of the same properties, plays a dual role. It is both monetary and industrial. That gives it a different volatility profile, but also a different kind of demand elasticity. In an environment of fiscal deterioration and monetary distortion, silver may even have more upside because its supply constraints are tighter and its market thinner. That makes it more responsive to marginal demand shifts, especially from retail and developing markets seeking hard assets in smaller units. What the comparison reveals isn't that one system is right and the other is wrong, but that resilience comes from diversity, specifically from anchoring a portion of wealth outside the control of any one system, institution, or technology. Digital assets may evolve and even mature, but they will never replicate the physical certainty that metals provide. Fiat may be re-engineered through CBDCs or stablecoins, but that doesn't resolve the underlying problems of trust, mismanagement, or overreach. Gold and silver don't offer answers to every problem, but they don't create new ones either. That is their strength, and in a world of increasing complexity and fragility, it is a strength that deserves renewed attention. There comes a point in every cycle, political, economic, and social, where the risks stop being theoretical and start becoming immediate. That's where we are now. The signals are no longer buried in technical papers or hidden within obscure financial indicators. They're in plain view. We're seeing increasing volatility in currency markets, persistent inflationary pressures, a breakdown in fiscal discipline, and growing reliance on monetary interventions that mask rather than solve structural problems. At the same time, the infrastructure of money is being rebuilt in real time, often by private actors with little accountability and a vastly different set of priorities than the public institutions they're quietly replacing. The transition to digital forms of money is inevitable. That isn't up for debate. But what's at stake is the direction and design of that transformation. Will it be a system that preserves individual autonomy, public oversight, and long-term stability? Or will it become a fragmented web of private tokens issued by corporations or platforms that are driven by profit incentives rather than policy coherence? The danger isn't just theoretical, it's systemic. Because if the architecture of money becomes divorced from the principles that have underpinned monetary stability for generations, the fallout will be felt everywhere and by everyone. This isn't a call to reject innovation. It's a call to engage with it critically, urgently, and with full awareness of what's being constructed beneath the surface. Most people don't realize how quickly change is happening or how fragile the current system has become. They continue to operate under the assumption that central banks will step in, that financial markets will self-correct, that the tools of the past will be sufficient to manage the challenges of the future. But history teaches otherwise. Once confidence is broken, once the foundational trust that underpins money itself starts to crack, it doesn't return easily. It takes decades to rebuild, and the damage along the way can be profound. So action now isn't just prudent, it's necessary. Diversification isn't a cliché, it's a strategy for resilience. That means holding assets that don't rely on promises, whether those promises come from governments, corporations, or algorithms. It means reassessing assumptions about liquidity, custody, and jurisdiction. Where is your wealth held? Who controls access to it? Under what rules can it be seized, frozen, or devalued? These are not abstract concerns in a world where geopolitical fragmentation, regulatory overreach, and systemic interdependence are all on the rise. Education is another form of protection. Those who understand the nature of the system are in a better position to navigate its flaws. That means studying monetary history, not just headlines. It means asking uncomfortable questions about sustainability, not just of the environment, but of debt, spending, and policy. It means being intellectually honest about the limits of growth models that depend on expanding credit in a world of finite trust. This is also a moment to demand more, not less transparency from those who are shaping the future of finance. Whether it's a central bank exploring digital currency issuance or a private firm launching a new stablecoin, the governance structures, collateral practices, and operational rules must be clear, enforceable, and aligned with public interest. Otherwise, we risk walking blindly into a system that consolidates power while reducing accountability. The window to make meaningful adjustments is not unlimited. Once systems become entrenched, they're difficult to unwind. Once incentives are misaligned at scale, reform becomes harder, and once trust is lost, whether in money, institutions, or leadership, restoring it requires more than policy. It requires legitimacy. The choice is not between tradition and progress. The real choice is whether we build systems that are resilient, inclusive, and anchored in reality, or ones that look innovative on the surface while hiding profound risks underneath. The time to choose is now. Waiting any longer means letting that choice be made for us. So yes, stablecoins may feel like innovation, but unless they are fully transparent, tightly regulated, and serve public, not corporate, peril, they become digital Trojan horses. They are private, sector mimicry of CBDCs that chip away at sovereignty, privacy, and real trust. If we let them fill that void, we won't just lose economic choice. We will lose freedom itself. Hold gold, hold silver, hold your financial autonomy, and demand public systems, not private substitutes, because the real wealth is not in lines of code, it's in preserving the system.